Have you ever heard of the ROE ratio? It's a financial ratio that measures the return on equity (ROE) of a company against its cost of equity. Today, we're going to take a closer look at the ROE ratio and how it can be used to evaluate a company's financial health. The ROE ratio is calculated by dividing a company's ROE by its cost of equity. The ROE is the net income of a company divided by its shareholders' equity, and the cost of equity is the rate of return that investors require for the company's stock. Let's take a look at an example. Say a company has a net income of $1 million and shareholders' equity of $10 million, giving it an ROE of 10%. If the cost of equity for the company is 8%, then the ROE ratio would be 1.25, calculated by dividing 10% by 8%. A ROE ratio greater than 1 indicates that a company is generating more return on equity than it costs to raise that equity capital. This means that the company is creating value for its shareholders. A ROE ratio of less than 1 indicates that a company is not generating enough return on equity to cover its cost of capital, which can be a warning sign for investors. The ROE ratio is a useful tool for evaluating a company's financial health and performance over time. It can help investors identify companies that are creating value for their shareholders and avoid those that are not. However, it's important to keep in mind that the ROE ratio is just one of many financial ratios that should be considered when evaluating a company. Other factors, such as debt levels, cash flow, and industry trends, also play a role in determining a company's financial health. That's all for today's video on the ROE ratio. Remember to do your due diligence and consider all relevant factors when evaluating a company's financial health. Thanks for watching.